China blinks, Russia threatens, and Democrats seal the deal in Georgia. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers on the search for growth in China and in the United States.
We're going to be seeing probably the biggest set of policy experiments that we've seen in China in decades.
And Jeff Blau of Related on why the market for upscale office space is hot.
You look at new modern buildings with the right features, the right amenities, and the demand for those buildings is tremendous.
Global Wall Street saw a week of confrontation as Democrat Raphael Warnock faced down Republican Herschel Walker in yet another runoff election in Georgia and came out the winner.
It is my honor to utter the four most powerful words ever spoken in a democracy. The people have spoken.
Ukraine continued its bloody confrontation with Russia, using drones to strike bases inside of Russia.
A third airfield has come under attack by drones. State-run TASS news service reported that an oil shortage tank caught fire. The attacks were the furthest penetration yet on Russian soil since the invasion began,
Provoking Russian President Putin to raise once again the specter of nuclear war.
Putin, however, I think has used this nuclear card an awful lot during these last few months of the war. And what he found out from President Xi of China is a warning not to do that.
And China took a hard look at the pushback from citizens over its zero COVID policy and decided to back down, at least a bit.
It includes measures such as allowing people who get sick to quarantine at home instead of a government facility. They're easing up on testing to get into public spaces, for example. So it's a whole series of micro measures that are being interpreted as another step away from COVID zero by the authorities.
Though it may have been encouraged by the dismal trade numbers, even as the United States kept up the pressure on semiconductors by breaking ground for a new plant in Phoenix.
These investments are helping us build and strengthen the supply chain here in America. I want to be clear. As we build a stronger supply chain, our allies and partners are building alongside us as well.
I'm not sure whether it was all that conflict and confrontation. It may just have been growing concerns over recession, but the markets were not in a risky mood this week, as the S&P 500 lost 3.4% over the week, and the Nasdaq was off almost 4%, while the yield on the 10-year dipped under 3.5 in the middle of the week, but ended up at 3.58% at the end of the week. Let's bring in now Ann Sonders, Chief Investment Strategist for Charles Schwab, for her view on what we saw this week. Ann, great to have you here in New York with us.
I am so thrilled to be here. First time back in studio in a couple of years.
It's a real treat for us. So give us your take on what we saw this week, because as I say, there were some indications the markets were getting a little nervous about risk.
So I think the economic data was, at least on the margin, weaker than expected. PPI obviously came out a bit hotter than expected. And I think that there's just more realization that the path from here is to slower growth. Whether we ultimately find it's declared an official recession, as you and I have talked about, I think we're in already a form of recession. It's just of a rolling variety. We've seen the hit to areas like housing, to certain segments within the goods side of the economy, the areas that had the big surge in the early stage of the pandemic. That was also the breeding ground for the inflation problem we're still dealing with. That then went into recession-type conditions, disinflation in the goods side of the economy, housing-related, but we've got the offsetting lift on the services side, which services is a larger employer, so that has kept the labor market afloat. But I think we're going to continue to see weakness roll through the economy. And I think whether it's ultimately declared an official recession is almost an academic exercise at this point.
Ann, looking back on it, I think it's fair to say we had asset inflation before we had real price inflation for consumers. Has the Fed been successful in pricking the bubble on some of the asset inflation? You mentioned housing, for example. We have cryptocurrency that's certainly taken a hit. For that matter, big tech has come down. Are we starting to see some of those asset bubbles at least deflate a bit?
Crypto, SPACs, NFTs, certain, if not most, pockets of the housing market. To your point, big tech, other narrative-driven speculation-driven areas like heavily shorted stocks, non-profitable, all of those, what we've been calling micro bubbles, undoubtedly have gotten not just pricked, but they sort of popped in spectacular fashion. You know, the good news is a lot of that speculative excess, even when we were in the heights of those bubbles, had not fully filtered over into the traditional market areas. And that's what we were always saying was very distinct from the current environment or the recent environment and say 1999, 2000, where the speculative excess was concentrated in the major averages. It's been just a little bit outside that mainstream, save for some of the big cap tech names. And I think it's just a valuation compression that was necessary in large part due to the inflation backdrop.
And yet, are we really fully seeing the effect of what the Fed is doing and saying in overall inflation numbers? As you said, PPI came in even a little hot this week. Consumer sentiment was sort of mixed, depending on whether the shorter term or longer term. And now we have CPI next week and the Fed. When will we start to see a real effect on inflation, do you think?
Well, in the case of a metric like CPI, of course, it's got a large component that is shelter related. So you've got the rent of primary residence, you've got owner's equivalent rent. Those components should start to roll over because there are sort of real gauges, actual rent gauges that we can all track. Zillow has one, Apartment List, RealPage, that have shown a significant rolling over in actual rents, disinflation in rents. It just takes a while for it to feed into the calculation of a metric like owner's equivalent rent. So I think it's coming, but it hasn't come as quickly as many would like to see. And there's other services-oriented components of the inflation data that just tend to be stickier. So we are seeing disinflation in some of the goods areas. We just have not yet seen the rollover in the services area. Now we've got another lift in wage growth, which is probably a bit unsettling for the Fed.
So one more here, if I could, Lizanne, and that is, unfairly, what we know a week from today we don't know today. We've got CPI, we've got the Fed coming out. We think we know what the Fed's going to say in terms of the rates. It's going to be 50 basis points. Will there be things that will actually materially affect an investor a week from today that we don't know today?
I think if anything, as it relates to the Fed, it would probably be during the press conference. I think those are always a bit more interesting than what you glean from the statement. But also remember, it's a December FOMC meeting. So we'll get a new dots plot. We'll get a new summary of economic projections. So we'll get a sense of what the collection of opinions at the FOMC is about the trajectory. That doesn't serve as a roadmap by any means, but I wouldn't be surprised if Powell starts to get peppered more in the press conference, not about what is the terminal rate, when do you think we'll get there, the notion of a step down, will you do another 50, assuming they do 50, but I think he's going to start to get more questions about the length of the pause. And not just how long do you think it will be, but what are the conditions under which the Fed, once they pause, would see a green light to consider easing policy. I think that will be the next, call it, set of questions that will probably be more prevalent in something like the press conference.
Ann Sonders of Charles Schwab will stay with us, and we're going to be joined by Peter Kraus of Aperture Investors as we turn to the question of what do investors do with all this, particularly those higher interest rates. That's coming up next on Wall Street Week on Bloomberg.
But wow, did the sky have to fall before investors would budge. Leading the dive bomber attack was the Federal Reserve Board, which appropriately chose the anniversary week of Pearl Harbor to raise its key discount rate a full point for the second time in 3 weeks, as if to say, now will you guys believe that we're serious?
That, of course, was Lou Rockheiser on Wall Street Week back in 1980. I'm working on a hairdo just like that. That was another time when the Fed was on a rate-raising campaign. Private Benjamin was the #1 movie back then, and the #1 song, well, that was Lady by Kenny Rogers. We all remember that. Still with us are Ann Sonders of Charles Schwab, and we are joined now by Peter Kraus of Aperture Investors. Welcome, Peter. Great to have you here with us.
Good to be here.
So once again, we're seeing rates rise, although not full points every 3 weeks, but still, they're going up, probably going to go up again next week.
Right.
What does that mean in a broader sense for an investor? I mean, this is a different world than we've seen for several years now.
Yeah. Well, look, I think if you look at a longer time period, think of it from a strategic point of view. Investors have been investing really in equities and very little in fixed income for 15 years. And people have moved away from negative interest rates. They've bought private credit. They've bought private assets. They've bought equities, assuming that that's where the return was going to be. So now you have a paradigm shift. And, you can't say, well, this is what I'm going to do with my money tomorrow. But over the next 18 months, you're going to see significant shifts of capital into the fixed income complex. That'll include longer duration securities. That'll include high yield securities. That'll include investment grade securities, which for the first time will actually be attractive. And it'll include the short duration complex as well. I also think, interestingly enough, emerging markets has got to be a place where you look. And emerging markets are down. The MB is down 20%, maybe 16% as of today. And it's probably got a yield of 8%. Next year, if everybody's predictions are wrong and the Fed doesn't raise rates by much, everybody thinks rates are going to go down, then more than likely you're going to see some recovery in emerging market debt, and that could yield 8% plus some price appreciation. You can see 10. So frankly, that's a place where I don't think people are looking, and I think probably it bears some thought.
If you take what Peter said, Liz Ann, ultimately, does that end you up in cash? Because that's the shortest term investment. You can move that around quickly, and maybe you have to get ready for a bounce back in 18 months.
So I think it depends on who the investor is. I think for investors that are much less risk tolerant, that if they're, and I'm talking from the perspective of individual investors, if they're older, if they're in retirement, they were forced way out the risk spectrum in a zero interest rate environment. And for anybody that doesn't have a high risk tolerance, that have those liquidity needs, that have the need to live off of income, getting a real yield on a cash-like or a very short-term security, that's the first time they've experienced that in quite some time. But I also agree with Peter. I think there are paradigm shifts that happen when you go through cycles, particularly when you go through a full cycle where you have an economic contraction and you go from a bull market to a bear market into a new bull market. There's always that recency bias. There's always that obsession with looking at what had been the leadership and feeling that there's not going to be momentum in an asset class unless you go back to that leadership. Leadership changes. I think there is opportunity in fixed income. I think there is opportunity international. We've got to look through the windshield, not the rearview mirror.
It's interesting. I just saw a note from Rock Creek, Afsani Beschloss's note, that said something I hadn't focused on, which is actually one of the winners this year has been Latin America. Mm-hmm. That Latin America has done surprisingly well. I've not been paying any attention to Latin America at all, I must say.
Mostly commodity-driven, oil-driven. That's what was driving that. But look, I don't think that we're saying don't invest in equities. Yeah. I just think that when you look at where your money is allocated, you're going to start to allocate more money to the fixed income complex. And pretty much, you're going to go through a period of volatility here where private assets are probably going to have some challenges. You won't be able to get any liquidity there. You're just going to have to hold them. So you're going to have opportunity losses there. You've seen some of that already in these large pools of private assets that have cash withdrawals or cash requirements. And I think you're going to continue to see that as people try to take their liquidity and get 8 to 9%, which they haven't seen for 15 years.
Listen, on this program, you've talked about a form of factor investing, different factors. I wonder if one of the factors is ability to service debt. I mean, we're starting to see now, as the interest rates go up, some companies are starting to struggle a little bit with paying back. We had Carvana go into a restructure this week of some of its debt. Are you going to have to look at that factor about servicing debt?
I think so. Self-funding. Yeah. Strength of balance sheet, high cash, lower debt, the ability to service your debt more easily. And you and I were talking before we came on about you don't wish ill on any company or group of companies or their employers, but what's happening now with this move off the zero bound is not just opportunities in asset classes like fixed income, opportunities for active, operating on a more level playing field relative to passive. But I also think price discovery is coming back into the mix, reconnection of fundamentals to prices, and maybe not an environment anymore that just keeps zombie companies afloat for year after year. And we're going through that.
A simple way to think about what we're talking about here is if you look at the various different credit cycles we've had since really 2000, in each case, there are between 150 and 200 defaults and between 1,000 and 1,500 downgrades. So This is a credit cycle that probably is not as severe as '07, but it's not benign. It's not zero. We know that the economy is going to slow. We know the revenues are going to begin to reflect the financial constraints of the Fed. So what is the default rate? Is it 100? Is it 200? Is it, are the downgrades 1,000 or 1,500? Is the market price for that? Are people ready for that? I don't think so. And I think it's impossible for that not to happen.
Well, listen, I wonder if people are ready for something else. Something that's different, I think, than, for example, '07, '08, is how much of it's private. Peter mentioned earlier private credit. We have private equity. We've got a lot of things that are not as discoverable and are not marked to market, frankly.
Right.
And I wonder if the market's prepared for that. There could be more damage out there than we know exists right now.
I think you're right. In fact, I've looked at data on the broad cohort of foundations and endowments, and just over the last 20 years, looking at their allocation to traditional equities, fixed income, and to the private markets, inclusive of PE and venture, and it's more than doubled. It's 50 to 55% of exposure to the private markets, and at a point where there's liquidity needs, and you've tied up that liquidity, I think it's a very different environment in the next few years relative to what it's been in the last 10 to 15.
It's a really important point, Peter, and I don't know if this is connected or not, but we saw Blackstone have issues with their REIT and really shut down some of their withdrawals, and then their private credit. And there may be no problem there at all, but it may be as people feel more pressure, they need that liquidity and start to take it out of some of those funds. It may not be that easy.
Well, I was referring to that earlier. I don't think there's going to be a run on the bank in either B credit or B REIT. On the other hand, I think it is crystal clear that the investor is concerned about the potential marks in those assets and the lack of liquidity that they have. And so that's a temperature gauge on the point that Lizanne is mentioning. Look, think about it this way. We've been running interest rates at basically zero cash and 3 to 4% spreads. Now we have 4% cash and 5 to 6% spreads. And your income, your revenues probably went up because of inflation, but your units probably that you're selling probably went down. And so your fixed charges have changed dramatically to the negative. Now, you don't have to refinance in 2022. You may not have to refinance in 23, but by 24, you're refinancing. And when you refinance, the bank's going to say, not sure I'm as comfortable with that much debt. And that's where this restructuring is going to take place.
Well, and let's add one final point on this. It's a question of who's temperature, who's comfortable also. Because it's one thing for an institutional investor who's used to this, can ride it out, no problem. We have a lot of retail investors now who are participating in some of these funds.
And that is where the absence of liquidity, they might not even have realized it. But when push comes to shove and they need that money, it's harder to access.
So is there a problem in private credit, do you think, overall right now?
There is an unrecognized loss. There is a restructuring activity to come, and there will be investors who conclude that locking up their liquidity for what you get in private credit is not as attractive as owning liquid securities, which now are actually providing attractive returns. So to the point made earlier about where the allocations of capital go, we've seen 15 years of money moving from public equities and public debt to private credit and private equity. That's going to reverse. It's not going to zero. It probably isn't going back to where it was, but it's not going to keep growing.
Last thought, Lizanne, is there also an opportunity? Usually when there's some destruction going on, when there's some tension, there's some bargain for somebody to come in and say, you know, I can pick it up pretty cheap.
I think that there are opportunities. Some of the rallies that we've seen this year that have not been long-lived have been way down the quality spectrum. There are times where you want to go down the quality spectrum when you're pricing in a real significant pickup. I don't think we're there, but the opportunities come with what's dear. Look for companies with positive earnings revisions, with strong operating leverage, with strong balance sheets. So there's ways to navigate.
Thank you so much to Peter Kraus of Aperture Investors and Ann Sonders of Charles Schwab for being with us on Wall Street Week. Coming up, we're going to take a look at the mood on Wall Street as we head into a bumpy patch. That's next on Wall Street Week on Bloomberg. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Bloomberg Wall Street reporter Sonali Basak got a ringside seat at the Goldman Sachs U.S. Financial Services Conference in New York this week. And this is what she learned about the mood on Wall Street.
Thanks, David. When it comes to the mood on Wall Street, a lot of the energy has been focused on talent. Talent is often the biggest cost, and for all the talk of potential job cuts and reductions in pay, it's worth taking a look at which jobs are under pressure, which are not, and how employees can adjust to new positions as they try to realign to a new macroeconomic environment. Now, bankers are looking to reinvent themselves. Investment banking at Bank of America is on track to drop by more than 50% this year, for example. And that bank has actually gained market share in mergers and acquisitions and investment grade underwriting during this weak market. CEO Brian Moynihan said the company is slowing hiring ahead of a possible recession, but he's also said they're trying to move traditional deal makers to new roles within the bank. He spoke to me at the annual Goldman Sachs Financial Services Conference this week.
We know we can absorb those teammates we by just managing our headcount carefully. So what do we do in times like this? You look at your open positions, you look at your fill rate, which is how many people hire as a percentage of people leave, and you shape the headcount back in across the whole company. We take some of the talent teammates in investment banking and bring them into other parts of the company at times like this.
Now, while a number of banks are starting to cut jobs by the thousands to prepare for lower revenue, there are some rivals who see an opportunity, especially in the smaller investment banks. Peter Weinberg, a longtime investment banker who co-founded Perella Weinberg Partners, said that recruiting is actually a key focus for his firm right now. His rivals at Lazard and Moelis are saying similar things.
Well, this is a wonderful time for us to hire, and we're very focused on that because, first of all, we have a growth plan that's sort of undaunted. Independent banks aren't for everybody, but there's still a lot of people at the large financial institutions who want to get back to client work, and they may be frustrated by the position they're in at that firm because they're overly burdened by leadership responsibility, whatever it might be. But it's more how they kind of spend their working day and their working life. And I think people, and it's not just us, it's all the independents, I think people find it very attractive to move to the independent platform.
Now, when I asked Goldman Sachs CEO David Solomon about the talent war, he hinted that the situation is really changing. Remember, it was Goldman where young bankers revolted in the last few years to push for higher pay. And then it was also Goldman where bankers were asked to come back earlier than any other financial firm headquartered in New York City. It was also Goldman Sachs where the news first broke this year that job cuts would once again be starting on Wall Street. Many firms believe that Goldman could create a standard in how pay and headcount are set for at least the next year.
The talent war is I think there's some headwinds given we're changing economic conditions, but the competition for talent is still very, very strong. Now, how that evolves in 2023 is unknown. Certainly, if we have a slower economic environment, it will have an effect.
There's a hope among some big banks that deal volumes will come back by the middle of 2023 as interest rates stabilize and markets could be less volatile. That would also cause underwriting for debt and equity deals to come back, and it would recreate the need for top talent. Until then, they're trying to hold on to their star staff. David.
Thanks to Bloomberg Wall Street reporter Sonali Basak. Coming up, we get a view on real estate in a time of rising rates from Jeff Blau, CEO of Related Companies. That's next on Wall Street Week on Bloomberg.
Real estate. It's the investment people turn to in times of inflation.
The real estate market is probably the best major market to invest in right now. Inflation in general is good for real estate.
And Rock Creek's Afsane Beshla says they are seeing portfolios shift to real estate as investors turn to private investments in an uncertain time.
The bigger thing that is happening in the portfolios we're looking at is obviously a lot of investors, institutional investors who've been also investing in venture, private equity, real estate in private form. And I think that is going through some sort of transformation too.
But with interest rates climbing, real estate is becoming trickier. Tom Shapiro of GTIS says the housing market is taking a real hit.
The housing market is tremendously decelerating at this point. Sales are off tremendously.
Famed investor Sam Zell says it may be worth less than the market thinks.
I felt that the real estate market generally has been overpriced, particularly on the private sector.
And now Blackstone has limited withdrawals from its massive real estate investment fund because too many people were taking their money out too fast, which Larry Summers sees as a potentially ominous sign.
When you see prominent financial institutions telling people that they can't take their money out, that's never a happy thing. Makes me wonder about what's ahead.
And we welcome back to Wall Street Week now somebody who knows real estate terribly well. He's Jeff Blau. He's the CEO of Related, and that is, of course, one of the largest real estate developers around the country. They have properties throughout the country, and last time I checked, the largest landlord in New York City, I think, Jeff.
One off. I don't know if we're the largest, but we're up there.
So welcome back. Great to have you here.
Good to be here.
So tell us about real estate right now. It has been a good hedge against inflation. Inflation is a problem. At the same time, interest rates are going up. And we have some real problems with some office occupancy.
Right. So you got a lot of topics in there. First, if you think about what's happened over the last year, we've had the fastest rise in interest rates in probably 20 plus years. And the impact on real estate is pretty significant. Now, you break down different parts of real estate because real estate's broad. So on stabilized assets, buildings that people own, whether it's apartment buildings or office buildings, in a way, inflation's good for those assets, right? Rents rise, they go up, and if you did a good job managing your assets, you might have fixed rate long-term debt, so cash flows increase. So in that bucket of real estate, inflation is a great hedge. Inflation's great for real estate assets. If you're in the funds business, and many of your viewers are, whether they're credit funds or equity funds, this is a great time for that business. The banks, as you know, have stopped lending or have certainly pulled back significantly, and so the private credit markets are booming because where they were competing with the banks in the past, they in effect could make bank-type loans at 2 times the rate. So that's a great opportunity for credit funds. Equity funds, we haven't yet seen real distress. We might start seeing that in the next couple of months. So I think the funds management business in real estate is going to be very strong going into 23. The difficult part for real estate is anything you want to do new. New development is difficult. There's not a lot of financing. There's not a lot of construction loans. Costs have gone up, so it makes it harder to build. So it depends where you are in the real estate markets as to what the impact is. The office sector, as you mentioned, that's a whole topic into itself. And I think really people ask me all the time, tell me about the office market. And really the office market is very bifurcated, and I don't think there's one answer again. What we have seen is a real dispersion in values between older buildings and brand new buildings. And it's not just new, it's new with the right features, the right amenities that tenants are looking for today. So we're seeing more and more corporations thinking about how do they get people back to their office and thinking about using the physical space as the attraction to bring people back. But truthfully, people don't want to go back to old, kind of quiet offices that are dark and have bad air circulation and long waits in the elevators and no amenities. So what corporations are doing is investing in their office space, not for occupancy, but for talent attraction and retention. And I think that's where you're really seeing the A buildings and the new buildings that are focused on this, that have the right amenities, that have the right HVAC circulation, that have hospitality type services, that have great air and light, and the right type of build out. The build out in office space is changing tremendously. Where we used to see kind of the old Mad Max version of a build out with private offices on the exterior wall and assistants' offices or cubes inside. That's really not the way office is built today. We're seeing much more collaboration space, teaming space, meeting space, food service, tables around food where people are using for gathering and working, as opposed to private offices. So this type of office of the future, we think can be successful and is successful. The data is there today for these new buildings. So we compared brand new buildings across markets in the United States, not just here in New York, and you look at new modern buildings with the right features, the right amenities, and the demand for those buildings is tremendous. And at the very same time, you can go a couple blocks. Like if you take Hudson Yards, for example, we just opened last week. Actually, our first tenant moved in yesterday. at 50 Hudson Yards. 50 Hudson Yards is a 3 million square foot building. It cost us over $4 billion to build this building. And it's essentially 90+% leased at this point. We're getting the highest rents in New York City in that building, over $200 a foot in that building. And because it has all those features and amenities, it is new, it has all those things that we're talking about. You can go 3 blocks away and find as much space as you want in B buildings. That's probably listed for $60, and they can't lease it.
So I want to come back to the B and C in a moment, but let's stay on the A, because even with everything you say about the A, are people needing a little less A space? I mean, we had the Meta situation actually in Hudson Yards, where they gave back 250,000 square feet. Are you seeing that more broadly, where people are saying, yes, I really like A, but I don't need as much of it?
So not really. So there's a couple different situations. So Meta, what Meta did is, when we made the deal with them, they're one of the anchor tenants, along with BlackRock in 50 Hudson Yards. When we made the deal for them to move into 50 Hudson Yards, that was 4 years ago, and they needed space immediately. So they took some swing space in 30 with the intent to move into 50. So that's the space that they are not staying in today. Everyone thinks there was this big announcement, but that was the plan. So they are moving the employees that they have in 30 Hudson Yards, which were in swing space, into 50. Now, to answer your question, there are companies like Meta today that are pulling back on office space in general, but that has nothing to do with their build out of the space. That's, the tech sector is pulling back, they're cutting costs. That's based on their business. That's based on kind of what's happening in the broader economy. If you ask Meta about their office space per employee in their new types of build outs, and so they have actually stepped back, rethought about the office space of the future. And it's all the things that I talked about. Much fewer private offices, much more gathering and meeting spaces. And when you take the same number of employees and compare the old build out and the new build out, the mix of public space and private space is completely different, but the total square footage per employee is the same. Now, if they're pulling back because of general economic issues, that's not a real estate issue, right? It's not an office space issue.
Let's come back to the B and C buildings, as we call them. I've read about so-called zombie office buildings now in New York City. They're really empty. How bad a problem is that? What are we going to see? What's the fallout? And by the way, does that also create some opportunities, some bargains to pick things up cheap?
Right. So I think it is a pretty significant issue for New York City. You've had some companies leave New York. You've had some companies suffer through the economic downturn and COVID and supply chain and all the things that have happened, and have vacated space in those B buildings. The problem is there's not a lot of tenants that want to release those spaces. So we're seeing vacancy in the B buildings increase significantly. We're seeing the vacancy in the not just A buildings, but in new product A buildings, which is, I'll create a new segment. So you have BA and new A. In new A is virtually no vacancy. So there could be opportunity. I don't think the opportunity is to buy those buildings because you can buy them cheap. I think there's a potential opportunity for conversion. It's a very difficult process. Everyone likes to talk about it, but often these buildings don't go from 100% occupied to 0, and then you can convert. So it'll go from 100 to 80 to 70. You still have lots of tenants in there. It's hard to convert. You've got zoning issues, cost issues, and tenants. So I don't think you're going to see a lot of it. People are talking about it. I don't think you're going to see a lot of actually happen.
Jeff, thank you so much. Jeff Blau, he's CEO of Related. Coming up, we'll wrap up the week with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston, and we welcome back now our special contributor on Wall Street Week. He is Larry Summers of Harvard. So, Larry, normally we talk about what's happened during the week, particularly what the Fed might make of it, what might happen with rates. But it strikes me there isn't a lot of that this week. Let's talk about larger issues that you are focused on.
David, I think it's important for us always to remember that ultimately trends are more important than events. And trends, most of the time, are positive, and events, most of the time, are negative. So we have to step back and look at things that may be markers of trends. And I saw two such things this week. China's huge evolution away from the zero COVID strategy and what happened with ChatGPT from OpenAI, which may be a marker of a profound change in what it means to be a machine and what it means to be human.
So let's take each of those up in turn, if we could, Larry. Let's start with China, because as you say, they really are backing off of their strict policy on COVID and the isolation and that they've been pursuing, and also a lot of the testing. But do we know yet whether that's going to be positive or negative? It could be positive for the economy, but on the other hand, if they have a real spike in cases and really overload their medical system, we may have a problem.
Look, I think we know two things. We know that a big change in China happened because of an expression of popular will and protests. That's a profound thing for the governance of that superpower with 1.4 billion people. You're quite right. We don't yet know how this is going to work out. Is this going to be a successful rejoining of the reality of the rest of the world? Or is this going to lead to catastrophic delegitimizing performance of the Chinese healthcare system? And we don't know. But either way, there's a big chance that China's going to be a quite different country 6 months from now than it is today. And so I think all of us are always watching China carefully, but we need to be watching China much more carefully over the next 6 months, when you're going to be seeing leadership change at the same, below the level of Xi Jinping, of course, at the same time that we're going to be seeing probably the biggest set of policy experiments that we've seen in China in decades.
So let's turn to that second subject, the OpenAI creation of ChatGPT. I won't pretend that I understand this, but I have read about it. Again, is this a positive thing or potentially a negative thing? Because we already have a lot on the internet. We don't know where it comes from or its origins. Now we're going to have something, we can't even tell whether a person created it.
Look, when I went to graduate school, we used to estimate statistical models with 5 parameters. Now there are going to be 175 billion parameters that go into one of these systems. The great computer scientist Alan Turing, 70 years ago, said that it was going to be a threshold for humanity when a machine could imitate a human being's answers to questions in a way where another human being wouldn't be able to tell the difference. We're somewhere in the territory of that right now, and that is a profound thing for humanity. It points to a profound change in the way we're all going to be working. We're all going to have a kind of caddy that, or many of us are going to have a kind of caddy that is going to augment our creativity, augment our capacities to bring knowledge to bear on what we do, augment our accuracy. But just as the printing press or electricity was a huge change because it was a general purpose technology, this could be the most important general purpose technology since the wheel or fire. And that is something we are all going to be changed by. My hope is that the very transcendence of these kinds of events can bring a kind of unity, because they are so large relative to the differences between Democrats and Republicans, or even the difference between the West and China, that these opportunities and threats, because they are both, whether it's microbes, whether it's artificial intelligence, whether it's climate change, that the very transcendence of these global events can become a source of cohesion and progress. But there is no assurance at all of that. We are living in truly historic times.
Larry, I want to talk about a different sort of threshold that I came across this week, and I was a little bit surprised. I was reading Bono, the leader of U2, his new memoir called Surrender. It's a fascinating book. I find it very, very compelling. And who do I find in there but one Larry Summers, when you were, according to Bono, a reasonably new Treasury Secretary. And he came in to meet with you and Sheryl Sandberg and Stephanie Flanders to talk about debt forgiveness for the poorest countries. And according to his rendition of it, you started with President Clinton, a real process that led to really historic changes in the debt of some of the poorest countries in the world. What about that? We've still got a long way to go, don't we?
David, Bono is an unlikely but very close friend. I will confess it, I'd never heard of him before we had our meeting, and Sheryl Sandberg had to force me to take the meeting because I thought secretaries of the Treasury should only meet with people who had a first name and a last name. But he was mesmerizing both in his charisma and his knowledge. And he drove that debt relief program forward. We had an unlikely coalition, Pat Robertson, Senator Jesse Helms, and we were able to do something that I think was hugely important for the African continent at that time. Sad to say, right now the world needs comprehensive debt relief for the poorest countries, and what the world is getting is grudging, incremental, partial, limited, small efforts. And we've got to find a way to do better. And I hope Bono's going to get the band together again. I'm certainly willing to do my part to help. This time it's going to be different because a lot of that debt is owed to China. And finding a way, even when things are vexed with China, to involve them in helping these countries move forward based on an understanding of how they see the issue is going to be necessary and profoundly important for a large number of human lives.
And finally, Larry, give us a moment, if you would, on what we normally do on this program, which is talk about what happens this week, and specifically on the question of the likelihood of a recession. We saw developments in the marketplace, oil price coming down, bond yields coming down, stocks coming down. Most people think that has to do with real anticipation of a significant recession. Where are you on that?
I've been saying soft landing, very unlikely for a while, and I think it's looking even more unlikely right now. I noticed that the consensus, as reflected by the FT University of Chicago survey of a group of 50 economists, is now moving closer to where I've been. They're saying that we're going to have a recession and that the unemployment rate will peak at 5.5%. That's up from where they were, way ahead of where the Fed is. I've been saying 6%. So I think there's a growing coming together that we probably are going to make more progress on inflation than many people expected, but it's because the Fed is going to do what's necessary, but there's likely to be some adverse aspect of that. But, you know, David, next week I hope we can talk about what's happening globally, because we tend to focus here just on the American picture. But the two other major poles of the economy, China and Europe, are both going to have a huge impact on how this all plays out globally.
Let's do exactly that next week. Thank you so much to Larry Summers, our very special contributor here on Wall Street Week. Coming up, to the winners go the spoils, or at least to the big-time pro baseball players. That's next on Wall Street Week on Bloomberg. Finally, one more thought. Maybe we're not really all in this together. Just about everyone, at least every economist, agrees that we are in for some harder economic times. And that includes former presidential economic advisor Glenn Hubbard of Columbia.
I think it's still likely that we will see a recession if the Federal Reserve pursues its path to get to 2% inflation relatively quickly.
But to say that we are all facing an economic downturn does not mean that we will all take the same hit from that downturn. Some of us will get laid off. which Morgan Stanley's Mike Wilson says is necessary and could actually be a good sign for investors, if not for the workers who are losing their jobs.
When that layoff cycle picks up in earnest, that will actually be one of the keys for us to get bullish, because that means the bleeding will stop on the operating leverage.
One of the first group of workers to get hit has been tech, particularly big tech, which in some cases may have been overdue.
The hiring that we saw through the pandemic, where companies like Amazon and Meta basically doubled the workforce, clearly there's some excess there that needs to unwind.
A thought echoed by Fortero's Dean Forbes.
Most of these layoffs at scale are happening in the supers, right? They're happening in the Metas, they're happening in the Facebooks, they're happening in Twitter. And to a degree, it's just kind of right-sizing.
Even if we're not losing our jobs, most of us are finding that we make less because of the bite of inflation. And now Goldman Sachs CEO David Solomon says that at least some of his bankers should expect cuts in compensation over and above what inflation is doing.
It shouldn't be surprising to people watching the performance of the business this year that 2021 was an exceptional year. It was a record year for the firm. It was the highest revenue year ever for the firm. 2022 is a different year, and so naturally, compensation will be lower.
But never fear, those layoffs and comp cuts won't be reaching all workers, not by a long shot, and certainly not if you are a star pro baseball player. Just last week, the Texas Rangers took two-time Cy Young Award winner Jacob deGrom away from the New York Mets, and in the process gave him a nice raise to $37 million a year. But the Mets didn't grieve for too long. They turned around and signed Justin Verlander, raising his pay to a cool $43 million a year, putting him just about on a par with his Mets teammate now, Max Scherzer. But then we had the Yankees step up with $360 million over 9 years to keep star slugger Aaron Judge in pinstripes.
$360 million deal for 9 years with the Yankees, that being reported by The Athletic, $40 million a year.
And I'm sorry, Lisa, it's just simple. Sports wins. The fact is, you see it in the signing season of baseball, big money is being thrown around.
Now, nobody can deny that all of these are truly great players, sure to make it into the Hall of Fame. But to put it all in a broader perspective, Mickey Mantle, surely one of the greatest players ever in the game, became the highest paid baseball player in the land back in 1963. And what did he get paid? A whopping $100,000 a year. And that is just over 2% of what Justin Verlander will make next year. And yes, that is adjusted for inflation. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.